All right, we're now moving on to Note 8, which talks about where we'll be talking about corporate formation and financing and carrying on basically from what we have been discussing in Note 7. I've changed position here. You're now looking at the forest across the street from our camp. I am sitting in a screen room. It is now 87 degrees out. There is no air conditioning here because we're in New Hampshire. And the position I was in previously was on the sunny side of the screen room, and it was getting to be rather warm. So we've now moved more into the shade, and I know because it's such a bright sunny day out, the backdrop's a little hard to see, but you're just looking at more trees. Okay, in Note 8, we begin by talking about a legal concept called piercing the corporate veil. Now, the corporate veil was originally a slang term for shareholder limited liability. And think of what a veil is. A veil is something that is worn to hide something else, to keep something separate and secret. And so the lawyers in the old days used to joke that limited liability for shareholders was like putting a veil over them. They were hidden, they couldn't be seen, they couldn't be sued, their assets were protected, and if you went to court because of something that the corporation, its agents, or employees had done, the shareholders were allowed to stand behind this veil, protected from whatever would happen to the corporation. So the idea of piercing the corporate veil means that somehow we get behind it, we pull it back, we pierce it, we cut it open so that we can get to the shareholders. And what started as lawyer slang in the old days in the old common law courts has become the legal terminology for this activity. So piercing the corporate veil is making an attempt to destroy the shareholder limited liability and to go after the assets of the shareholders for whatever wrong the corporation has committed, either criminally or civilly. All right. It is easier than you would think for this to happen. Although in the case that we looked at with Doe versus Gelano, one of the cases we had to brief, the Rhode Island court talked about how, well, we don't like to do that and we're going to make it difficult, and they gave a whole list of things that just because this happened or that happened or this happened, we're not going to say that the corporate veil disappeared here, that it was pierced, and that you can go after another entity, you can go after the shareholder entity or the parent entity or whatever. But there are some very easy ways, particularly in small businesses, that people fall into that will allow courts to look at what's going on to say, no, there really wasn't a corporate structure here. You filed the paperwork with the Secretary of State, and anybody who went online or went down to the Secretary of State's office and looked at your papers would think that everything's well and good and this is wonderful, but in your business practices, in your day-to-day operations, you were doing things that are not appropriate to a corporation. You were acting as a sole proprietorship. You were acting not as if you were a shareholder, but as if you were the sole owner. So therefore, we will say there was no corporate existence at this point, and we'll allow whoever is trying to sue to go through that corporate shell and to go directly against you, Mr. Shareholder, Miss Shareholders, whatever the case may be. Usually this protection is removed when officers and directors have been acting for their own benefit in ways that abuse a corporate structure, and particularly if those officers and directors are shareholders as well, which happens in many, many situations. There is no general prohibition against a shareholder becoming an officer or a director. So they can be a shareholder, and if they decide to take on one of those positions and that they are elected to it by the majority of shareholders, then they are in a situation of being a shareholder and of running the business. And certainly you can see we're in small corporations owned by one person or in closely held corporations owned by 3 or 4 people. They are usually also the officers and directors and the people running the corporation. Acts that would lead to piercing the corporate veil are the corporation never makes a profit. It always carries a loss from year to year to year. In effect, it looks like the shareholders are putting their own money into it every year to keep it going. The reality is that that's not a business. and that the only reason you file this corporate paperwork is to somehow try and protect yourself from liability for something that you're doing in your life. If all income is taken by certain individuals, so if the income is basically stripped from the corporation, there's no investment into new things, there are no employees, you're paying only the minimum bills that have to be paid, and all income is being dumped out to one or several individuals, is another indication that this is really a sole proprietorship. It's not a corporation. If the corporation was formed to try and evade some legal obligation that already existed, you already knew there had been an incident for which you might get sued. Oh, so let's set up a company. We'll throw that piece of real estate into the company. We know a tenant fell down and was seriously injured on a broken step we refused to fix. If you fail to follow corporate formalities, and this is one of the things where most of my small business people get themselves into the most trouble. There is by law a certain requirement that corporations have an annual meeting of the shareholders, that they take corporate votes, that they keep track of paperwork as to who becomes an officer, who becomes a member of the board, who becomes a director. There are certain votes that need to be put in place when you borrow money, when you begin new business adventures, and particularly, again, in small corporations and family-held corporations, people tend to forget this, and they don't want to pay the lawyer to take care of this, and they ignore it, and then if they get sued, they now find out they've ignored that to their peril. Certainly failure to file tax returns for the corporation, failure to file an annual report, which is required of all corporations. You have to file paperwork every year with the Secretary of State. In Rhode Island, there is a minimum corporate tax that has to be paid whether the corporation had any income or not. If you fail to do those things, the court would deem you to have lost your corporate status. The Secretary of State and the Division of Taxation will not wait. They can actually revoke your corporate charter, at which point the corporation ceases to exist. Legally, it can be reinstated upon doing the proper paperwork and filing the missing things and paying fees. But if you don't reinstate it and then you get sued, you can again be in a position where a judge is going to say you let your corporate existence lapse. You are operating as a sole proprietor. Commingling corporate and personal assets. Again, in small corporations, this is a very, very, very common thing that goes on, and people get themselves into all kinds of trouble with this. When you set up a business corporation, whether it be a subchapter S or a chapter C corporation, regardless of how it's being taxed, you really need to get a separate tax ID number. You need to set up accounts that are corporate accounts. You need to keep those separate from your individual accounts. The corporate accounts should be opened up under the corporate tax ID number. Your individual accounts should remain under your individual accounts. And there should be some mechanism that is agreed upon by all the shareholders to get profits from the corporation to the shareholders in an organized and a rational manner. You cannot on a Friday night just write a $300 check out of the corporate account to go out to dinner that night with your friends, to go out drinking. You cannot go to the corporate till. That's an interesting concept. You guys may not know what a till is. In the old days, a till was basically, before there were cash registers, in every business, they would keep a pot or a bucket or some box, cigar box, with money to make change in it when transactions were all done in cash. So every business would have an amount of money that would be there for the day, so that as customers came to buy and sell, to do goods, they would be able to do cash transactions and make change immediately for the customers. Those, whatever that container was called a till. As cash registers became very common in the late 1800s, early 1900s, that slang kind of carried over in business, and today we kind of use it metaphorically for any cash that's left on hand. You cannot be dipping into that for your personal uses unless you're keeping extremely careful records about that. Failure to do that will not only get you into tax issues, but it is one of the major reasons why courts would choose to say you have pierced the corporate veil. You were not maintaining the corporate structure as to funds, and making sure that funds came in, went first to pay bills and employees of the corporation, to pay the debts of the corporation. You were willy-nilly grabbing those monies, using them for your own needs, and particularly if you end up in situations where you have to dump money back into the corporation because you took too much out last month when you went out, and now the corporation's at a deficit. Oh my God, I have to write a personal check back. If a court sees those, they're going to be inclined to pierce the corporate veil and say that you were not running this as a true corporation, you were running this as some kind of private enterprise, and a private enterprise is a sole proprietorship. You do not have limited liability. For larger corporations, particularly those if they are traded on the open stock markets, this rarely is an issue because those corporations are required to have open books to a certain extent, to make annual reports to their shareholders and to the Securities and Exchange Commission of the federal government and the various state regulatory agencies of open corporations, and therefore it's more difficult for them to operate ultra vires and to have the corporate veil pierced. This is usually more of a problem with smaller corporations, with corporations that maybe large numerically, may even have a lot of employees, but if they're only owned by 3 or 4 shareholders, sometimes they get into problems with this. And certainly corporations owned by 1 or 2 individuals or by families are certainly an area where these 10 things can happen, and it can end up with the corporate structure being ignored or voided by the courts. Alter ego, I have on the notes, is a corporation owned or controlled by 1 or a few persons, and it's not really a corporation. Again, they've just set up this paperwork to somehow try and grab limited liability, but they're really operating as a sole proprietorship or a partnership. So in effect, the corporate structure is nothing more than an alias, an alter ego for a sole proprietorship or a partnership that should be held, the members of whom or owners of whom should be held personally liable for anything that the corporation has done that would merit a lawsuit against it. Now, corporate financing. Corporate financing is an incredibly complex and intricate area. There are attorneys who do nothing in their careers but write and review corporate bond issues, corporate borrowing of money from banks and other institutions and other entities. It is a very highly specialized area of law. If you can get yourself into it, and that you usually get into it by going to work early on for a firm that does those types of things and becoming good at it, and having the firm want you to do these types of things. So in effect, you very often only get into this by way of a semi-apprenticeship as an attorney. It's a very lucrative field for the attorneys who are in it, but it is very highly specialized, and it carries tremendous liabilities for the attorney, because if a company issues $10 million worth of bonds and the lawyer does not do it correctly, there could be $10 million up for grabs here that the lawyer could be ultimately held responsible for. Now, corporate financing. How do corporations raise money? Corporations can actually borrow money, and in exchange from individuals, and in exchange for borrowing the money, they give the individual something called a bond. A bond is a loan to a business. It is recognized by a written document, and usually the bonds are in set amounts. So a corporation will announce that they're going to sell a series of $10,000 bonds. Each bond will cost $10,000. It will have a set interest payment. Interest will be paid periodically, each month or semi-annually or annually, quarterly. It will be stated right in the bond how that is to happen. And at some point in time, it will be required that the bond will be repaid in full. That whatever principal amount the buyer of the bond paid will be returned to them in whole. Popular devices, because they are guarantees, basically, that you will get your money back after a period of 2 years, 5 years, 10 years, 25 years. There are some 30 and 40 and 50-year bonds. And during the period of time that the bond is outstanding, you'll be getting a guaranteed income from this money. So bonds, particularly before the stock market started going crazy in the last 20 years or so, Bonds were a very, very large means by which corporations raised money, and by which even individuals, small individuals, would put together their savings, their retirements, and they would buy bonds from stable companies, knowing they were going to get paid a set rate of interest that is usually higher than whatever interest rate the banks are paying for deposits or for certificates of deposit. And for eons, bonds were the staple of American business. Now, as the stock market began to rise dramatically in the late 1990s and is still going up at this point, bonds have become less desirable as inflation has set in. And don't let anyone tell you that there is no inflation. There is inflation. When I was a young man in college, I could buy a loaf of bread for 30 cents and a pound of chicken for 29 cents and put myself through law school for the week on basically $1.50's worth of groceries. That is no longer possible 40 years later. So there is inflation. For those of you who don't know what that is, inflation is the idea that the price of items is going up within the economy, so that there's a general rise in prices. Bonds are a very bad deal when there is a significant amount of inflation going on, because although there are some bonds that are indexed to inflation, so that the principal amount owed back to the bondholder would go up according to however the inflation has been going on, most bonds are not. So if you pay $10,000 to buy a 30-year bond, at the end of 30 years, you're running a great risk that your money, your $10,000, is not going to buy anything near what it did when you first bought the bond. So bonds have become somewhat less desirable in recent times. They're still there. There's still a major way for corporations to fund their activities. They are still purchased by insurance companies, pension plans, other types of investment companies as a stable way to invest assets, and many, particularly pension plans and insurance companies, they have legal requirements. They are fiduciaries. They are holding that money for the people that are insured. They are holding that money for the people who have paid into the pension and are hoping to use these funds for their retirement income, and they are required by law in most states and under federal rules to keep certain amounts of their assets in what are considered stable entities. And bonds still today are considered far more stable than buying stock. So bonds are still a very big part of the financial markets. They're still out there, and they're still a way for companies to finance themselves. Stocks. Now, a stock or a share of stock, all of those phrases mean the same thing. It is a percentage ownership of a corporation. It is, in the past, had been indicated by the corporation issuing a piece of paper called a share, stating that John Smith, by virtue of paying $10,000 to the Coca-Cola Corporation, hereby owns 1,000 shares of Coca-Cola Inc. And that written piece of paper would be your evidence that you were the shareholder, that you were a partial equitable owner of Coca-Cola Inc., of the corporation. Today, this is all handled on computers, just as it is with money in the bank. There are not real dollar bills backing it up. There are ones and zeros and blips on the computer screen. Shares are most often handled by computer, and they are held in the computers of the corporation, the computers of the various stock exchanges. But the concept has not changed. When you, as an individual, buy a share of stock, you have become a partial owner of that corporation. If there are 10 shares of stock rolling around out in the public, you are a 1/10 owner. If something like General Motors or Microsoft, where there are 10 million shares or more floating around, you become a 1/10,000,000th share owner of the corporation. Now, being an owner of the corporation does not mean you have the right to go to Seattle or to Redmond, Washington, and demand that your chair and your desk and your piece of the corporation. It means, again, you are not the legal owner. You hold the equity to the company. That gives you certain rights, and those rights are somewhat limited. It gives you the right to vote in corporate elections, usually, although we're going to see in a minute, not always. And it gives you the right to participate in the profits of the corporation, so that whenever a dividend is declared, you get paid a dividend. And it gives you certain rights to vote for directors, officers, and to make decisions on a large scale about corporate activities, but you're not allowed to be involved in the day-to-day running of the company. You don't own any specific piece or asset of the company. And the other basic right you have is take your share of stock and sell it, if that's to your advantage, to a third party. Stocks. To simplify this tremendously, we can break them down into several different categories. All right, we're only going to talk about a couple here. Well, actually, we're going to talk about several. Common stock. This is what we generally think of when we think of shares of stock. Common stock is what the regular shareholder has. Common stock has voting rights in it. It has a proportional ownership right in the company in it. It has the right to share the earnings of the company. It gives the shareholder the right to vote, usually one vote per one share, which again means if you buy 2 shares of General Motors, you're not in control. The people who own 1 million shares of General Motors, they're in control. But you still have the right to go to the corporate board meetings, eat the buffet, walk around, hobnob with all the hedge fund owners and other corporate financiers and Wall Street people, and vote your 2 votes when the time comes. Right? Preferred stock. It's a little bit different. And preferred stock usually means 2 things. Number one is preferred shareholders get paid dividends first, so that whenever dividends are announced, they get their share before anyone else. And if the company dissolves and does not have enough to pay everybody back, the preferred shareholders get paid pro rata for their ownership rights in the company before the common shareholders do. In order to get these 2 benefits, most types of preferred stock say that you have to give up your right to vote, so most preferred shareholders have no power to vote in the corporation. All right. Still talking, jumping back now to ways of corporate financing. There's something called venture capital, which has become quite the thing in the last 30 or 40 years. Venture capital is the idea of you have people who have too much money, they don't know what to do with it, would like to find ways to earn lots more, and they will subscribe, they will agree to put up money for a new corporation in exchange for shares of ownership or in exchange for the right to cash in for shares at a certain time. So in effect, they are financing a new company that may or may not fail, and the vast majority of them do fail, but if the company takes off, they will now have become owners on the ground floor of that company. A very good friend of mine when I was young happened to, by accident, buy 100 shares of $1,000 worth of shares of Microsoft when it first went public. Somebody had said to them, this might be a good idea. This person bought them, didn't know what to do with them, didn't really play stock, and held on to them. And within short order, within less than 10 years, his shares were worth over $400,000. That's an example of what can happen with venture capital. If you are willing to go in at the beginning of a company and take a risk, sometimes the rewards are extremely great. This is the game of capitalism. This is the intriguing part of capitalism, the fun of capitalism, that even people who have a little bit of money can invest in something new, something dangerous. They can never lose anything more than what they have decided to invest. However, if their hunch turns out to be correct, they could become incredibly wealthy. If you ever see the term IPO in your financial readings or heard on the news, initial public offering. This is another form, not quite venture capitalism, because usually venture capitalists are dealing directly with the people who are trying to set up the corporation. The corporation has not gone public yet, but very often when a company goes public for the first time, there is a rush to buy their stocks because, again, people want to get in at the ground level. They want to buy stocks the first day that the stocks have been put out into the open markets where people can bid and trade and buy and sell them, and where the prices can go up and down, on the theory that many times the prices go up dramatically within a year or 2 years, or sometimes even within a few weeks or months. Private equity capital is a little bit different in that it is using private money to purchase the control of corporations. So somebody will come in, and usually this would be a bank or a big insurance company or a big pension fund, and say, well, yeah, you have a good idea there, and we like it, and we'll buy in. However, we're not too sure about your business skills. We're not too sure about your management skills. We want to make sure you don't run off with the money of our folks that we're investing here. So they will insist that as part of investing, they purchase a controlling number of shares so that they basically can make decisions about the corporation, even to the point of throwing out the original people who set up the corporation. If it's not working out, they can make sure that they do not get reelected to be officers or directors, which in effect puts them just outside the walls, being mere shareholders of whatever shares they took. Now, stock can have par value or no par value. In the old days, they used to set a par value of stock to make people think it was actually worth something. And basically, par value, when stocks were initially being offered, meant that you would sell the incorporators would sell the initial shares of stock at that amount to every investor. Today, par value is almost totally ignored. We issue stocks, we register them with the Secretary of State having no par value, not meaning that they're worthless, but meaning that when it comes time to issue and sell them, we're going to let the market decide what it's worth. We're going to see what investors and potential shareholders would be willing to pay for them, rather than trying to set a value in advance. And then, so in effect, the value is going to fluctuate. It's going to go up and down with the markets. Preferred stock, as we said, they usually have priority in payment of dividends, and they have priority in obtaining your investment back upon dissolution. They do not vote. There's another class of stock called cumulative preferred. If you buy a cumulative preferred share in your share of stock, it says you're entitled to a dividend at a certain period of time, which might be a quarter, it might be semi-annually, it might be annually. If the corporation has no money and misses paying dividends for a period of time, cumulative preferred stock gets paid first, but they get paid for every missed dividend. So let's say the company you have a share of cumulative preferred stock that says you are to get a quarterly dividend. The corporation goes for a year without making dividends, and then it has a really good quarter and they decide to announce a payment of dividends. You, holding a cumulative preferred share, would get 5 shares of that dividend. A common shareholder would only get 1 dividend at that point in time. So cumulative being your right to obtain dividends accumulates in time, meaning that sometimes you're going to get paid way more in a dividend than the common shareholder would be. Participating preferred. You get your dividends paid first, but you would also participate in any dividend paid just to the common shareholders. So it's a form of double dipping. When it came time to pay the common shareholders, you would get paid a dividend, then you would get paid again to equal whatever was paid to the common shareholders. Convertible preferred. Generally, preferred stocks are not voting stocks, and sometimes people decide they want to become voting participating members in the corporation. So some stocks are written with language to say that upon the happening of certain events or at certain periods of time, the preferred shareholders can convert their shares to common shares, which then gives them the right to vote and the right to have control in the running of the corporation. There are redeemable or callable preferred shares. These are shares that, in a way, they're almost like bonds, because the corporation has the right to buy back these shares at the happening of certain events or at a certain time. So you buy the shares of stock, and basically you own them and you get dividends on them, whatever. But if a certain event happens, the majority shareholders of the common shares can decide to call your stocks to redeem them, and whether you want to or not, whether financially that would be the best deal for you or not, your shares can be bought back, and usually the price